Nowadays, many retail traders or option buyers understand how to read candlestick charts, yet under the pressure of live markets, they often make errors in interpreting the charts and end up facing losses. To help you avoid such mistakes, in today's video we will discuss some key pro tips for chart reading. First, we will explore how to apply basic price action, and later we will cover the crucial concept of smart money, which can completely shift your approach to analyzing a chart. So let's begin, but before that, if you find this content useful, be sure to hit the like button, and if you are new, subscribe to our channel and turn on the notification bell so you never miss our latest uploads. I will see you right after the intro and disclaimer. With pro tip number 1. Price action candle formation. To understand this better, we will divide it into 4 sections. First, let's focus on candle size and location. Here below, you can see 4 chart scenarios, where in each case the market is moving upward with a bullish trend. In all 4 conditions, the market has risen by about 100 points. Now, by observing these candlestick charts, can you identify in which scenario a retail option buyer would gain the maximum benefit? Think carefully about it and share your response in the comments. As far as I know you, your answer will likely be the 4th chart, since you analyze properly after the market closes. But during live trading, many of you would have faced losses by taking entries in the other 3 conditions, except this one. To avoid such mistakes, you must clearly understand both the candle size and its placement. For example, if you look at the candle size in 2 of these charts, you'll notice large candles forming repeatedly, yet the following candles often close in the opposite direction. Because of this, the price requires more time to move from one level to another. On the other hand, in the last chart, candles consistently open above each other, which causes the price to rise faster and cover more points in less time. This allows an option buyer to gain more profit, since theta decay here is minimized. That's why, while analyzing charts, it is crucial to evaluate not only the candle size but also their position. If the candles on the chart are large but keep closing in opposite directions, then it's better to avoid trade entries in that area, because both buyers and sellers are uncertain about market direction, creating the risk of a sudden price drop. In such cases, there's no clear momentum, which makes option premiums decline rapidly and steadily due to theta decay. This back and forth fluctuation also increases the likelihood of your stop loss being triggered. Therefore, always examine candle size along with its location. Now, let's move ahead and understand the role of candle wick and candle closing. In this chart, the price rises from bottom to top and attempts to break its previous high with a strong bullish candle. Seeing this, many retail traders enter long positions, but shortly after, the candle closes below the swing high. When the market approaches the same level a second time, it forms a long upper wick candle, then reverses and closes within the same range. As a result, traders who entered long in expectation of a breakout get trapped, because what is currently unfolding on the chart matters more than what may happen next. In trading, excessive optimism often leads to the biggest losses. What you believe does not influence the market, your focus must remain on what the chart clearly shows. Whenever price breaks an important swing level by moving steadily above it without pausing, the buyers positioned below already secure profits. These traders usually expect a pullback due to profit booking near the recent swing high. Unless fresh buyers create new positions here, the chances of that breakout holding are very low. By examining the size of the candle wick, you can also identify the presence of sellers. Each time price reaches this level, it immediately reverses, signaling that sellers are active and unwilling to allow the market to push higher. The longer the wick of a candle, the stronger the rejection from that side. Therefore, if rejection candles form repeatedly in the same direction, you should avoid taking an entry until price breaks that wick high and closes beyond it. Still, many retail traders attempt multiple entries on such breakouts without proper consideration, and end up losing a major portion of their capital through brokerage. In this chart, after a sharp decline, the price repeatedly approaches the same level and takes support, resulting in nearly identical lows forming on the chart. When price halts several times at the same point and continues to respect that level, it creates an area of interest. This indicates that a large number of retail traders are eager to enter trades around this zone. If price attempts to break this support, some traders will prefer to take short positions, while if the market breaks above the trend line, others will look to go long. Because of this, there is a strong likelihood that major institutional players may create fake breakouts on the chart in order to trap retail participants. Since such levels hold psychological significance for small traders, they tend to trade aggressively at these points. Therefore, whenever equal highs or lows, support and resistance levels, or supply and demand zones appear on the chart, you must trade cautiously. Avoid entering a position until the price confirms a strong breakout and sustains above or below that level in a clear direction. There is no need to force entries. Now, let's apply the smart money concept of liquidity and inducement to better understand how to read a chart. Let us now use the smart money concept of liquidity and inducement to read a chart. Let us now understand its importance. In this chart, after dropping from the higher level, the price pauses at the lower levels and attempts to build support. Since the price continues trying to move upward by taking support from the same zone, an area of interest is established here. That's why, as the range forms between the upper and lower levels, retail traders wait for its breakout. Soon after, a strong green bullish candle breaks the range on the upside, prompting many retail traders to enter long positions. But shortly after, the price reverses downward, hits their stop loss, breaks the support, and declines further. As a result, retail traders who entered both short and long trades face losses. However, if you had analyzed this chart using the smart money concept, you could have avoided being trapped. First, when price drops and consolidates for a while before resuming its bearish move, traders who missed short entries earlier initiate fresh short positions here, placing their stop losses around this level. This creates a liquidity area. When price repeatedly moves downward near a certain level and holds, retail buyers place long entries with stop losses below that support, anticipating a breakout. At this stage, liquidity builds on both the upper and lower sides of the chart, which acts as fuel for the market. Because price has attempted to move above support multiple times, buyers accumulate heavily at this level, increasing liquidity further. To capture that liquidity, large institutions first generate a breakout candle to create upward inducement. Seeing this, new buyers open long positions and place their stop losses near the support area, which adds even more liquidity. After this, the market sharply reverses, sweeping the liquidity above and capturing the liquidity below. This is why you must understand the concepts of liquidity sweep and liquidity run. Now let's see how you can read a chart using the RSI indicator. Here we have the chart on a 5-minute time frame, where the market price is consistently falling and forming lower lows. After some time, however, the market reverses sharply and moves upward. If you want to catch such reversals, you can combine RSI with smart money concepts. For example, in this chart, while price is making lower lows, the RSI indicator is forming higher lows near this swing low. This signals a shift in the relationship between price and RSI, which in trading terms is known as divergence. Since price is heading downward while RSI trends upward, this indicates a bullish divergence, which can help identify a potential bullish reversal in the market. If you take a long entry at the high, with your stop loss placed just below the tweezer bottom candlestick, you can capture this reversal using a small stop loss and secure strong profits. At times, after your entry, the market may trigger your stop loss before attempting to rise again. This often forces traders to re-enter the same position, leading to additional losses. That's it, traders. Thanks for watching this video. I hope you gained real value from this video. If you did, make sure to hit that like button. It truly supports the channel and shows us you're enjoying the content. And if you're new here, don't forget to subscribe for more trading strategies. Thanks for watching, stay disciplined, stay consistent, and I'll catch you in the next episode.